Hello there. This is Randy Ward with Everoak Wealth Co., and I'm one of the financial advisors and partners here. We are in an election year, which brings out questions in all of us. I get the pleasure of talking to you about how elections have impacted markets historically, some thoughts on this election. While those historical pieces do not predict what's going to happen, it does bring about some very interesting insights. This initial slide here is going to have some good data. It shows essentially since 1937 what's happened when executive and legislative branches are Democratic, Republican, split, not. On the far left is a fully Republican executive and legislative branch where markets have returned 16.1% from the S&P 500 whenever there's been a Democratic president, with at least one part of the legislative branch being Republican. We have 14.4% rate of return. Next to that, fully Democratic, and finally, a 9.1% Republican president with at least one part of the legislative branch being Democratic. Now, that's actually pretty darn good, getting 9.1% as the worst sector. So what we can really see from this is whether it's split or all Republican, all Democrat, not a bad time to have invested historically based on this pure metric. One piece that the U.S. Bank Investment Research Team is quoted as saying, a review of historical data indicates that there's little correlation between national election outcomes and capital market performance. Full stop. Essentially, stop there, but I won't. I'll keep going on. So, what's really happened in more detail during election years versus not? That's what we came here to look at. Now, if we're going back to 1932, we can actually see that election years have had slightly lower rate of returns than the S&P 500 compared to non-election years. However, it's really been much more of what's happened in those years outside of the election that's caused the market to underperform. If you think of most recent history, the Great Recession in 2008, hugely negative, impacting the markets. In 2000, we had the start of the tech bubble bursting. And those components, especially when there's only rate of returns to the positive every 4 years, to allow that to still be a pretty good rate of return is interesting. And those two outliers have thrown off that. But overall, things look quite good regardless of election year versus not. Now, a bit more detail on that is showing each presidential election since 1964, what's happened leading up to the election the previous 12 months, what's happened exactly 12 months after the election date, what's happened the full calendar year of the election. You can pause it here if you want to look at this in more detail. It's pretty interesting. What it's shown in general is that, again, it goes back to the economic factors, not the executive branch that's factoring into market rates of return. And that's highlighted particular on this next page, which shows overall presidential rate of returns from the stock market. George Bush ended in the Great Recession. Nixon had stagflation. Those were the only two presidential terms that had negative rates of return. Again, this chart is showing stock market rates of return on the y-axis and GDP growth on the x-axis. So those pieces together essentially showing how well the economy did, how well the markets did during that time frame. And it was events outside of the executive branch that caused for the only bad term. So whether it's blue or red, overall markets have done very well. From that perspective, this is the first 2 years after elections and how the markets have reacted. Very similar, surprising to most people. So in general, the market is agnostic to who is in office. It's much more important as to what's going on. To further reiterate that, sometimes we'll get the question of, based on policy and agenda, is there a certain investment that we should look at? One common thought is energy. When you look at market rates of return, exactly the opposite of what you would think is what happened. So under Trump, clean energy stocks had a phenomenal rate of return. Oil did quite poorly. Under Biden, oil has done quite well. Clean energy has not. So from those perspectives, it's certainly not going to look at the agenda of the executive branch to figure out what a good investment is. Really, when we're looking at investments, it's much more about what innovation's happening, what's driving productivity. This is a pretty interesting chart. It just shows over the last 16 years what innovations have come about. We didn't have Uber 16 years ago. We didn't have iPads. Artificial intelligence has been a big deal over the last 12 months in the markets. All of these disruptors that will help drive profit, create new segments, create productivity, those are what the market cares about, and in the end is what's going to cause growth. Sure, the election may have some volatility, as we saw, but it's much more important what's happening within the economy outside of that and what growth is happening. So thanks for taking the time to learn a bit about the research we've done, and we hope you have a great day. Thank you so much.